introduce yourselves a little bit and tell the group how you came to be, how you were attracted to, how you came to be doing board service with, especially with pre-IPO going public companies. Jack, do you want to kick off?
Sure, I can do that. Hello, everybody. Good to see you. Hopefully you'll find today informative. I'm Jack Lazar, as Alison mentioned. I like to say I'm a recovering CFO, kind of like Christy. We did it for many years. My last job was at GoPro. I was the CFO of GoPro. Prior to that, I was at Qualcomm, Theros, a bunch of other companies, but basically a bunch of companies that went public. I decided in 2016, very deliberately, that I wanted to do boards. And I specifically decided that I wanted to do boards that tended to be private companies that wanted to go public. So that was kind of my niche, is that I could help with that process, since I'd done a bunch of IPOs. Since then, I've been on the boards, let's see, private companies, Eero, Tile, Tonal, and then a bunch that we've actually taken public: TubeMogul, Casper, Quantana, and the most recent one being thredUp. Actually, the very most recent one was GlobalFoundries, which went public last week. I also sit on some larger boards like GlobalFoundries that are public, and a company called Residio, which was a spin out of Honeywell. So I do kind of a mix of all these things, but what I really enjoy is this whole process of going from private to public more than anything else. And I will say that the way in which I got into it was through the advice of my friend Chuck Robel, actually. And Chuck told me, look, there's a bunch of venture capitalists out there that are on boards today, and they want to get off of boards when they go public, and they need people like you and me to fill those slots. And that's kind of what I used as my wedge into a bunch of these companies, was just basically a bunch of friends in the venture industry. So I'm sure we'll talk a lot more about it, but you want me to hand it over to Seth? You want to go next?
Great. Seth, you want to go next?
Sure. Hi, everyone. I'm Seth Goldman. I started Honest Tea out of my house 23 years ago now. And so started from the most modest possible way to launch a company. And we built a private board and kept that intact until Coca-Cola became an investor, and then had a fusion of Coke folks and my co-founder Barry and another board member. And then along the way, I also joined the board of Happy Baby, which was a private company that ended up selling to Danone. And then as Honest Tea was scaling within Coca-Cola, I started to get involved in Beyond Meat. It was a company my wife had read an article about and just sounded really interesting. So I sent an email to info@beyondmeat.com and said, you know, what you're building sounds really exciting. If there's any way I can help, I'd love to, and became a board member, and then eventually executive chair of the board, and helped take the company public and grow and scale. And then last year transitioned to just chair of the board, so not an executive role. And I am now launching two other new businesses. One is a branded company called Eat the Change. It's planet-friendly snacks. And then also a restaurant chain called Plant Burger, PLNT Burger. And so I have exposure at all sides of it, and really enjoy the challenge of building and scaling mission-driven businesses.
Fantastic. And then Christine.
Sure.
How you got to be doing board work with pre-IPO companies.
Great. Christine Gorjan. I spent the last 15 years of my career as a CFO at Netgear and Arlo. Joined Netgear right after they went public. And when I left, we spun out a division of Netgear, which was Arlo, and we did an IPO and a tax-free spin. So I had some experience there, and you know, started at Netgear when it just went public. So the boards that I'm on Invitae, a genetic health company in the city, joined it right after they went public. Then Juniper Networks, again, a bigger company and in the same space from an enterprise as Netgear, which is a great model for good governance and everything as we're trying to grow the smaller companies up. And then I've joined the board of Zymergen, which is a biotech company, and also Carbon Health, which is a private company currently. So, you know, I do like the bringing in the company and growing and watching them just kind of get better, at everything they do. So I think it's, I do it because I really enjoy it. And this way I get to experience 4 different companies rather than just one.
That's fantastic. And then, before we sort of dig into the whole IPO topic, I thought each of you are involved in such interesting companies, mostly disruptors. So I thought you could maybe just comment on what's it like taking on the challenge of being a disruptor and, competing with incumbents with a lot more resources, people, existing customers, often much larger. I'd love to just hear a few thoughts from each of you on that experience. Christine, you want to start?
Sure. I would say Invitae, when they went public, is really disrupting the standard, genetic testing where you would just get one test because potentially you had the cancer gene or that. And they've come in and disrupted, again, everything with technology and a combination of technology and healthcare. The whole goal was to bring the price down, to have a fulsome test where you're testing more than one gene, getting all the testing done, and really, bringing genetic healthcare down to everyday people in just preventative care, preventing people from a diagnostic odyssey in that. So it really was a different way to do it, and also to bring the cost down to the realm of where everybody could be able to do it. And I think that, the key there is you're going up against the big guys, but there's also a lot of challenges to that. So we had really good investors that have stuck with the company, and it's continued to grow. And in that healthcare space, there's a lot going on every single day. So, I really think they had a good idea. They had some of the best genetic minds in the country on that with Randy Scott and that. So it's really been fascinating to watch them grow.
Seth?
I think the key is to really make sure the company and the board is focused on what really makes the company disruptive and sets it apart. So for Beyond Meat, it was very clearly, and is still clearly, our R&D, our capabilities, and our team. And so that's where we put the investment. That's where we put in recognizing it's going to take patient capital to get there. Even as we sort of went through our IPO process, there's a dual track process. So you speak to other companies and you realize other, protein companies in the space sort of have a half a person dedicated to this area. Beyond Meat now has 175 people dedicated to it. And there's just no way you can sort of reinvent the biggest category in food with half a person. So for us, it was, having the remit from the board to say, this is what is critical for us. This is what we're going to invest in. And obviously doing that means it's going to have a long horizon before you sort of reap the returns on that investment, and just understanding that dynamic.
Great. Jack, anything you'd like to add?
I think both Seth and Christy have hit on some key things. I mean, look, in the end, if you think about a startup, it's really, a startup's a bunch of people looking at a problem a different way, is kind of the way I look at it. And so by definition, there's generally some, either you're blazing a new trail into a new market, like, Seth was talking about Beyond Meat's a good example of what was relatively a new market, right? Or you're looking at doing things a different way. And if you're looking at doing things a different way, you're generally dealing with some big company that's got the innovator's dilemma problem, and they're putting 2 or 3 people on it, as Seth said, as opposed to actually concentrating on what's the problem. And I think that's what makes these companies far more interesting. I love my big companies, but it's a lot of corporate governance, frankly. And this stuff is more about making business models work. And, good example is, I'm on the board of thredUp, and thredUp is basically it's the largest marketplace for secondhand clothing. And, there is a huge problem with secondhand, with clothing, just eating up the environment in landfills, and secondhand clothing is a good way to solve it. If you go to TJ Maxx and talk to them, they'll tell you there's no problem at all, right? And as long as they keep saying that, I'm the happiest person in the world, because that means that we just get to keep pounding out at a market that is evolving a lot faster than their their low cost market that they're going to be pushing. Or even in something like GlobalFoundries, where TSMC is the largest foundry in the world, and GlobalFoundries decided to look at it a little bit differently, focusing on kind of trailing edge stuff as opposed to doing all the sexy stuff that everybody wants to do at the leading edge. So I think it's the way you look at the markets that makes it more interesting and fun, and frankly, a lot more challenging with these private companies.
Great, thank you all. I think that's sort of a good backdrop to this whole discussion. So moving on then, so we're talking about the IPO process here, but how does a board come to the decision to go public versus staying private longer? And these days there are a lot more ways to become public, right? The whole SPAC market has sort of gone from sort of fairly obscure a route to something that's very mainstream, direct listing. What has your experience been in your boardroom sort of thinking about, do we need to go public or not? And if so, what are the pros and cons of the different routes? Anyone want to kick us off with thoughts on that?
I'll go first on that. I think the key really is, what is the asset you got? And is that, I wouldn't be worried about the mechanism. I would first make sure, is this an enterprise where we think we have long-term disruptive potential, where we'll benefit from having access to capital in a way that will allow us to continue, especially if it's innovation, to continue to keep a long-term perspective. If the trade-off means we have to go public and then we have to start focusing on quarters, then it's not worth doing. But and so for us, we certainly looked at the marketplace and said, we're at the time, Beyond Meat eventually did our IPO. We were at 87 million in sales, so we knew we had a lot of runway ahead. We're dealing at a category that's $1.4 trillion. So we knew we were at the very, very beginning of that. And then there's a question about the right mechanism, and certainly I have opinions about SPACs, but it didn't even factor in. It was really more a question of, is this a company where we think we'll have a trajectory of growth and our long-term vision won't be compromised by going public? And for us, the answer was yes to both.
I would say when we did the split out at Netgear, we really felt like we had one IoT business and one networking business, a subscription business, and buy a router and buy another one in 4 years. So the thought was that there would really be, they really were different products to be run by different people. One was, almost all software versus the hardware and software. And so that run by different management teams felt like each business would get more investment. And especially, having the capital to be able to potentially buy other companies or do some interesting things with the capital. So I think that was, one of the big decisions there. And then I still believe same thing, access to capital and that, but do you have a good business? And when you start small, do you have the metrics, or what are your key indicators that are going to be able to bring that street along with you on the journey as you grow? I feel like it's hard to get those defined and make sure that's what you want to go public with and what you think will do well. So I do think there's got to be a lot of thought into that, because everybody goes public with some kind of hiccup eventually, and how can you keep that to a minimum?
Yeah, great points, Chrissy. I say that as I used to be a supplier to her. When I was at Atheros, I used to sell semiconductors to Christy. She was a pain in the butt to deal with. So, but it was two very different businesses that they had at Netgear. I'd say a couple of things. First, in the old days, I would say this was all about access to lots of capital, but I don't think that's the truth anymore. I mean, I think back to my first IPO in the early 90s. And I think we raised $35 million in the IPO, right? So things have changed a lot. The access to capital in private markets is far more available than it was even just 5 or 10 years ago. So what used to be a big driver was you needed really a lot more capital. That's not the reason to go anymore, right? And that's why you see a lot of these companies have stayed private longer, because effectively all of the buy side is moving further down into the private investing world, and they're willing to fund these things before they go public. So What is important is, I would say, a couple of things. Number one, for a lot of my companies, particularly my consumer companies, it's a great branding event, right? You know, many of you may have seen what happened to GoPro when it went public, and it went to the moon. I mean, I couldn't go to any place on earth where they weren't talking about GoPro. So it can be a good thing and a bad thing. So you have to be careful, but it can really be a lot of good branding. It also helps to create a lot of momentum. If you have a lot of momentum going in your business, it's a good time to go public, because, and this leads to something every one of my private companies has heard from me. I believe that an IPO stands for not initial public offering. I actually believe it stands for I predict on target. Okay, so if you cannot predict your business, do not go public. You will be sorry, right? And so that's the thing that you really have got to be prepared for when you're going public, is a very good understanding of what is going to allow you to predict your business over and over again on a quarterly basis, because there are no excuses. The dog can't eat your homework when the quarter rolls around. You got to make your numbers, right? So that's the biggest thing to focus in on with the companies. Last thing I would say, and this was very applicable to my last IPO, which is GlobalFoundries. Sometimes you go when the market is telling you to go. Right now, the market is red hot. And it was very obvious a year ago that the market was going to be probably not this hot, but very hot. And so we pushed very hard a year ago and explained to the folks at GlobalFoundries and Mubadala, the primary investor, why this company would be in a good position to go public come this time this year. And you know, when you get a chance, you know, you can take advantage of that part of the market, and that's one of the things I think we did at GlobalFoundries. I hear there is a shortage of semiconductors. Probably not a bad idea to be in a foundry business when there is a shortage of semiconductors. So. Alison, you're on mute.
Yeah, thank you. You would think we would all be much better at this by now, me in particular. So we started to talk about this, but you know, obviously, I think all of you have had you've had several experiences of taking companies public. So what is, from all of that, what is your advice based on sort of lessons learned, things that go wrong, wisdom? Like, what are the most important thing a board should be thinking about or do to be IPO ready?
Well, I'll jump in to start, but so clearly I think predictability is pretty damn important. So if you can't predict your business, don't even think about it. That's kind of the number one thing. Look, I really do believe that you want to get some good experience around the table. That can be a CFO, because a lot of times the CEOs are not experienced with doing an IPO. And look, an IPO is just another funding event. It really is not a big deal. In fact, I've done private rounds that are more complicated than public filings. But it is very helpful to have someone who understands the buy side and the sell side and the process and all of that kind of stuff. And you can do that through consultants, but a good CFO is always going to be your best solution for that. That being said, this is also what leads to the lack of diversity on management teams. So what I believe in is get some good people on your board. And I'm saying this from a biased point of view, because in theory, I think I'm a good person on the board, and this is kind of what I do. But I think if you have someone who doesn't have the experience yet has the people around them to help them through this, it's just as effective, right? But you got to get that experience around you. You don't want to screw this up, is what it really comes down to. And yeah, the bankers will help, but you know, the bankers have their own agenda. You have to remember the banker's going to move on to the next deal. You're not the customer. The buy side's the customer. And so what you need are people that understand the process and are going to be honest with you. So I think boards, advisors, things like that are really important to get surrounding you as you're ready to go and make that leap into being a public company.
And I would say if you have ambitions to do that, it is never too soon to start preparing, because I'm watching them with, you know, they're on Excel spreadsheet for doing some accounting, and and this, the lack of systems, and you don't need to have great systems, but you've got to have something and a path for that. And I do agree. I mean, on most of the boards I'm on, I am a mentor to the CFO. Have they, do they not, with not having public experience in that, and I enjoy that and kind of be able to work with them. But I do think it's just never too soon to prepare, and I would hire up a little bit, hire somebody that get a mix of some public experience in there if you can, or people that have done bigger jobs, because the company should do nothing but get bigger if the plans go forward. And you want to make sure as there's more work that they can take on more and really go across different areas in that. So I just really think you can't get ready too soon, and you really need to hire up.
And I'll just add, you certainly need to think about, there's certain qualifications you just must have going public. And so on the audit committee, you need a chair of an audit committee who's signed a public filing before. And, at Beyond Meat, we had a great audit committee when we were private. We had someone who was a CFO of Stonyfield Farm Yogurt. And that she was very capable, but it was a private company. And so we went out and we got Kathy Waller, who was the CFO of Coca-Cola, and then Ned Siegel, who's the CFO of Twitter, which was a great blend and balance for what we needed in a finance audit committee, because, a real large CPG and then a large tech company. And so that would create a great balance. And I think the other thing is, and I think Christine kind of mentioned it, but, at least 18 months prior to the IPO, you can't have these people just fly in and all of a sudden, pretend to really be familiar with the company. And of course, audits, having a professional audit done well, and you don't want your first one or even second one, when you're a public company.
Great. There's a great messages starting to come up on chat, by the way. So thanks for that. And I encourage everyone to keep adding them. So Kim Box's question, which you started to touch on, actually, is board composition pre-IPO and then post-IPO. So just talk a little bit more about that. Like, what are you've already started to, but what are the skills or board attributes that are most helpful during this process and afterwards? And also maybe separately, that's advice to people in terms of how to sort of connect to boards looking for new board members through an IPO process.
Yeah, I guess I'd follow on what Jack said. I'm seeing companies add independent board members pre-IPO, which is good. In fact, on Carbon Health, I think I'm the 4th independent, which is great. But I really think it's, what mix do you need? Do you have somebody with industry experience? Have they been a public company CEO to mentor the CEO? Same with the CFO role. And is it marketing you need, or do you need technology, CIO type? So I really think looking at the skill sets that will help them as they make their journey from private to public. And I do think it's a nice balance between the investors and the independents. I think that's a good thing for the management team, is so that they can work with both. So I think the sooner you can get some independent directors on, and then, what is the mix that you need? On Carbon Health, we have someone who's been in the healthcare, but also in regulatory, which that's really important as they go forward. So I really think just really sitting back and don't pick someone because they, I don't know, we're a governor of a state or something like that, unless what skill set do you need? Because it's work. Like Jack said, you're working with the company on the business. It's not just sitting and getting reports and reading them. It's not great governance. You're building the governance there. So I think it is a lot more work and takes a lot more time to devote to it.
I think it's great that you have 4 at Carbon.
Yeah.
Because in the old days, when I first started doing this, I would say it was more like I used to call myself the glue, right, between management and the investors. Because, I'd have a bunch of investors that put a lot of money into the company who I usually knew. And then I had a founder who I got to know when they were looking for one independent for their board. And you spend a lot of time kind of refereeing when there's a problem, being the person in the middle. And when you have a series of people, it actually helps, it helps out quite a bit, actually. Generally now, I think there's a trend to see, at least a couple of independent investors in these private companies. And it's frankly a great spot for people to learn how to be directors too. I think it's probably the best fix we have for fixing some of the diversity issues into to public companies, is getting some experience into these private companies that then leads you into the public companies. So I think that's all good. I totally agree with Christy though about the whole idea of having these different functions being added. You tend to see the finance people being added pretty early because there's audits. We tend to do M&A transactions or IPOs, things like that. But like, at Tile, we have a real go-to-market specialist, a woman who is the CEO of a company that's in a similar space, who's on the board. She adds a tremendous amount of value. So I think you're starting to see a diversity of talents coming into the boardroom, which is also a good thing. The last thing I'd point out is that you're starting to actually get a call from employees to see more diversity on your board, which is, I'm literally seeing it, and it's awesome, right? I mean, they'll say, well, how come we don't have anybody that looks like me on this board, right? Because it's a bunch of old white men on the board, because that's what most of the venture capitalists are. Yep. That stuff's changing, and it's changing not only from the mentality in the boardroom. I think most of the investors get it now, but also it's bubbling up from the employee base too.
Yeah, and just to echo that, I mean, I think it's natural for innovative companies to start with a lot of venture board members, and they are important for a stage of the company. But as you start to shift toward public, you really need to bring in our case, food people with food background, right? We're a food company, so we need people with restaurant experience or production experience, sourcing, and so that's a natural evolution. And frankly, the VC board members should recognize that's a natural and healthy transition.
But that's also your opportunity too, right? So find those VCs, get to know them. And like I said, my pitch to them was always, hey, you've known me for years. I'm going to be someone you can come to even when you're gone off this board, right? Mm-hmm. And that generally tends to work pretty well.
Hey, there's some great questions coming through. So I think Rich Horan has one. Any insights on company culture change of an IPO transition? I think that's sort of interesting. Have you seen the culture change in positive ways and negative ways? How to sort of manage a great culture through an IPO?
Well, the obvious one is information. So information by definition has to change. The information flow has to change somewhat when you go public. One of my favorite tricks when a company's going public is, everybody's used to getting all of this financial information, right? Mm-hmm. And you can't do that, right? And you have to restrict it more. And what I tell people is, so you can have all that information if you want to be on the blackout list. And it's amazing how many people will give up their access to information when they find out they can't trade their stock, right? So I think you have to find ways to turn that into a positive though, right? There's going to be things you need to be sharing with the company. You need to have an openness, but you need to be smart too, right? You don't want to get in a situation where anybody starts doing things based on material non-public information, and we end up in bad places for everyone. So that whole thing is a very difficult thing to control as you're going public, I would say. And it's an evolutionary thing. And I think you just need to be very aware of it and draw some lines and then really try to figure out ways in where you can be more open with the employees in different ways.
I remember after the IPO, we came back to California, and one of the folks who was at the IPO said, "Oh, well, you should have a monitor in the reception area when people walk in that shows the stock price." And I'm like, absolutely not. That would be the 1000% wrong thing to do, because there'll be days where the stock price goes up for nothing anyone in this building has done. And there'll be days when it goes down despite amazing things happening here. And so, it's important to think about what are the touchstones around culture and in a sense, really double down on those to the extent you can, so make sure people don't get caught up in all the distractions, which they really, for most of the company, what's going on in the markets is a distraction from executing their jobs.
Yeah, and I find, some of the employees are, why is our stock down today? Why, why is it up? And I'm like, you just can't look at that every day. It's not your job. And I tried to have them not, focus on it as much, but obviously they do. So, but I do think the culture is really driven a lot from the CEO. And I think once the CEO goes from private to public, they have an extra job being a public company CEO, and they're now on a quarterly treadmill, and they have to answer, other than their investors, it's the general public and investors. So it's different. And then I also think they really have to double down on the culture to keep the people informed in that. So I think the CEO's job is huge. It's big to begin with and bigger. And so they really have to have, what does that executive staff look like, and who can they really rely on and help with that? And delegate. So I think that management team is really critical in that, to allow them to move forward in a positive way.
Yeah, I thought of one kind of funny story I'd add on to this, because I've seen so many IPOs. One of the things that's very common in an IPO is that you will do a reverse stock split. And it's usually because you have too many shares and you're trying to get the right number of shares out there, so that, from a CFO perspective, we want to have enough shares where we can beat by a couple of pennies every quarter. And, there's a lot of reasons to make a change to your number of shares. And I had one company where I was a CFO where we went public, and I had someone come in to my office and tell me that we were screwing them because we did this reverse stock split. And as you probably all know, a stock split is very simple. It's either, I call it 2 6-packs or a 12-pack. I don't know which one you want, but they're the exact same thing, right? It's has the exact same value. And he literally was an engineer. He gave me a spreadsheet that showed me why I was wrong, right? And I turned to him and I said, you know what? Really appreciate you doing this. The only thing I know for sure is that your spreadsheet is wrong somewhere. I'll find it and I'll show you why you're wrong. But you are getting the exact same value with this reverse split that you had before the split. So this is something, it's a cultural thing that you kind of have to go through with employees. And you have to be patient, because especially with engineers, they tend to want to overanalyze everything. But you just have to take the time, explain, and they're going through this for the first time, and it's a cultural change that you have to kind of digest. So there's a lot of stuff like that you end up going through.
Great. Good discussion there. So Andrew Shapiro has a good question. It's sort of going back to this, SPAC versus traditional IPO topic. And the question is, assume there are two companies that are equally, ready, prepared, predictable, strong teams. They're equally ready. What are the pros and cons, if any of you have sort of have a perspective on this, of SPAC versus IPO? And as we all know, I think there is many hundreds of SPAC teams fully funded, sort of looking for companies. So most of us probably are connected to companies who've been approached by SPAC teams. So it's something that, boards are likely to have to think about.
Well, I'm biased because we did the IPO, but to me, the IPO advantage is that there's an underlying asset investors know they're investing in beforehand, and then the tires get kicked. I mean, the process, the testing the waters in the roadshow, there is a real due diligence process. But literally, by the time you're done, thousands of investors have looked at it, and so you don't have that in the same way with a SPAC. And so, and I've heard, I haven't been part of a SPAC myself, but that I heard the sponsors do very well, and not necessarily always the entrepreneurs or even the investors who with the enterprise versus the ones on the outside. So I think the question is there an underlying asset of value? And if there is, I don't think that the shortcut of the SPAC is really that much more advantage. I'm sure someone could put up a different argument, but for me, the IPO entity to me is a more proven, known commodity.
Mm-hmm.
I actually have a question for you on that, Seth. So
Yeah.
let's fast forward to today. And let's say Beyond Meat was starting up today.
Yeah.
This would be a perfect type of SPAC
Mhm.
company, right? Big market, conceptual in the early days. Do you think the team would have looked differently at it if today's market environment and you guys were earlier stage?
Yeah. And I have been part of a lot of other companies that have asked that question. And in my case, I just say, like, if there's a value here, I don't see the advantage of doing a SPAC versus the IPO that much. I mean, why? So I would say, let's really, if we think we hold up to scrutiny, if we think, we have an asset of value, let's not hide anything. Let's not try to take a shortcut. Let's do it. Maybe it's a longer way to do it and perhaps a little more expensive, but at least in food, I haven't seen SPACs. I certainly don't have regrets about what we did. And I would be a voice to do the more conventional IPO route.
The only thing I would sort of add is that, some of these SPAC sponsor groups actually bring a lot of value added to the table, right? Experienced board directors, sort of support to the management team. And, I think in some cases that's a plus, and in some cases it can be less of a plus.
Yeah, the one thing I would say is it does, if you did that and you mix the boards, you have the company board and then you add a couple of SPAC people all at the same time. I think that makes a hard time on the board for the next year. Everyone doesn't know the company as well as the other person does. Everyone has to make sure that they all fit and get along and govern the company. So I do think when you kind of take a half out of somewhere and a half coming out of the SPAC, that it is a tougher road on the board, that you haven't added them sort of one by one and move forward. So that's something I've seen.
Yep.
Just to add on here, I was really curious what your response was going to be there, Seth. So thanks for being honest with us.
Sure.
I'm personally not a fan of SPACs, period. And I think SPACs exist today because the IPO process is relatively broken. And I think they exist today because money is free. And the two of those have come together and provided an alternative financing vehicle for, frankly, things that I think in most cases shouldn't be going public, because they can't predict on target and they don't really have established markets yet. I do think the good part about SPACs, though, is it is forcing some change in the IPO process. IPOs are actually getting more efficient. Just went through one where, it's not a bunch of people in the back room just coming up with a price. It's actually people putting in orders for different volumes at different prices and actually coming up with a more efficient process. So I think SPACs are good from that perspective. But, overall, I don't think there's a lot of advantages to going public via SPAC. Some people argue it's time. I don't think it's time. If you're already on file, it doesn't matter. It takes longer to go via SPAC. Some people will argue that, frankly, the markets will accept it earlier. That's true, but maybe you shouldn't be going. But overall, I think that if you're going to do it, you might as well do it the right way and fix the process.
Hey, so Patsy Deutsch has a good question here. She's interested to know, since all of you have been involved in a lot of companies, is it more typical that the board sort of triggers or suggests the IPO timing, or does management come to the board?
Management usually wants to go public. That's my experience. It's in the old days, that was the only way to get liquidity, right? Now today, there's a lot of secondary rounds that are done and founders are finding liquidity pre-IPO, but historically it's been management saying, hey guys, I want to make some money, right? And I want to take this thing to the next step. I also think the other big reason is it's a real credibility thing with customers, right? If you're a public company, it's a lot easier, frankly, to go out there and sell if you've got the public company credentials behind you. So my experience is it's generally going to be management that's pushing it, but I don't know what Christy and Seth are saying.
No, I would agree in most cases. I would say on the spin side, it was maybe a little different. but on the IPO side, it's management.
Yeah, and with us, I would just say there was alignment. It was, I think everyone sort of had this as in our sights, and then just it's a question of timing. When's the right time to do it? And you know, and so it was kind of at that moment where we felt like we'd figured out the business model, you know, got the margins right, and we're ready to get onto the global stage.
Do you, Mark Zorko has a question for any of the panelists. Can any of you, have any of you been involved with foreign companies trying to list in the US? I mean, I have one experience, but I'll ask the three of you first.
Yeah, I'm on the board of GlobalFoundries, which is a foreign, it's based here in the United States, but we're a Cayman company, just by way of which it was organized. So what that means to me is I'm the audit committee chair, and it's IFRS based. So I've had to actually learn some things on this one, and I think I still have a lot to learn, quite frankly. What I've also learned along the way is there's different timing on things. You know, my proxy statement's a lot different. My filings don't have to be done in the same type of timetable as I would have here in the US. So it is very different. But if you're filing and listing in a US exchange, the actual process itself is not really different. Yeah,
the only thing I would add, I'm the audit committee chair for a data governance company called Calibra that is based in Belgium, but planning to list in the US. And I just say criticality of having sort of very experienced external counsel who understand both markets, and then having a experienced CFO executive team who really understand what they're doing in US markets. But it's not a well, I mean, there are plenty of companies who've done it successfully. So there's also other companies to learn from. It's a great question here from Andrew Shapiro, talking about, Christine, you and Jack in particular sort of came to the board roles, pre-IPO company board roles because of your financial expertise. To what extent do you think, most of the people here on the call have significant public company governance board expertise? Is that really considered to be value added as technical expertise, or is there plenty of it out there, and companies are looking for different skills on the board than just good solid public company board experience?
Well, when I'm on my boards and even in my CFO role, I think, your legal department is got a lot of governance experience, and we rely heavily on them and our outside counsel. So I do think, what's funny is when I'm interviewing for a board, and as I got on one, being a CFO that's what I do. That's what I'm supposed to be. But am I a good business person? What else do I bring to the board? And not just, the CFO. So I think they're really looking for people that, did you grow a business? What difference, what have you done to help the business? So I do think the governance side isn't looked at as much. You can get that internally. You're always going to have, somebody, and honestly, your audit chair probably has done that before, because they've been sitting in the boardroom on the other side of the table for 10 years before they go on a board. So I don't know that they're necessarily looking for that. I really think it's more of what technical expertise you have, or what great business, or you do a lot of M&A, turnarounds, SaaS models. They're looking for that. I don't know, Jack, what you think.
I totally agree. I was just thinking my first public board I joined was Silicon Labs in 2014, yeah. And I had obviously no board experience, public company board experience. I had been sitting in boardrooms for 25, 30 years, right? So that's helpful, but it wasn't like I was going to walk in and I knew all the governance stuff, right? And I had never even been an audit committee chair at that point. But what they wanted was a financial person in the semiconductor industry that had M&A experience and was in the Valley. So I kind of fit that one pretty well. So I think the goal was to make me audit committee chair at some point, and I was for 5 or 7 years. But I don't think it was that important in getting in. I think as long as you've got a couple of people who actually have that experience on the board, everybody else, these are smart people. I mean, you're all really smart, accomplished people. We can learn this stuff. It's not that hard, right? And I think that's kind of the attitude that we generally take in the boardroom. I don't know, Seth, you got anything to add on that?
No, I just, I always think about people wearing different hats. And so, yes, assume everyone's smart and capable and experienced. Then, at least with us, do we have someone who knows food service at scale? Do we know someone who knows about how to globalize a brand and a business and manufacturing at scale? Obviously, the audit and those kind of skills. But then, is there somebody who's sort of come from the meat industry? We're a meat company, different kind of meat company, but someone who's come from the meat industry would be a good fit. So, it's really about the specific skills. The only other thing I'll say that I think is a critical one is there someone who's been either a founder to CEO or at least been a CEO of a large, at scale enterprise, because they're going to understand and be able to empathize and recognize patterns for the CEO in a way that, someone else might not have.
Hey, it's some great questions coming up here, by the way. So question from Catherine for the three of you. Have you ever turned down board opportunities? And, if so, why? And, I think especially scaling companies looking to go public, can be more opportunity, but more risky as well. So interested in any experiences you've had there.
I would say yes. And part of it is it just wasn't as interesting to me. I mean, where they were on the journey or what they were doing, or they were too far, some of the pre-IPOs are really many, many years away. And then it really would just depend on what the business was and do you like working with the people? So I think for me, you want to like what the business is, and you want to like the people and think a lot of them and what they're doing. So it has to be a fit, and it usually ends up, a fit on both sides.
Yeah. I've turned down lots. One of the reasons is focus. I just need to make sure I'm still building, I'm still CEO of a company. So I need to make sure I have the ability to focus and build my enterprise. The other one is just, Beyond Meat has a very broad charter. We're in meat, but we've also, we've got this partnership with Pepsi where, obviously that could expand into adjacencies. And so I just need to make sure there's no potential conflicts of interest in the plant-based space. But that doesn't stop me from, advising or offering sort of just friendly advice to folks. And certainly a lot of the food, I think not almost all, but numerous food companies that have gone public, I've talked to along the way.
Yeah, I too have turned down quite a few, but for many different reasons. One, I would just recommend to people, if you get a call for a company that is trying to go public and they're maybe 3 or 6 months away, they've already started writing an S1, you should run, don't walk away from those, okay? That means they didn't care enough to actually get the right people in place to start. And I do not like situations like that. I like to join boards where I know people. I get to know the CEOs. When you're joining a board, you're generally going to join it for, 5 to 10 years. And if you're going to do that, then you need to be really smart about your time. So that's probably a very common one. Is I get phone calls from a recruiter saying, we're looking for someone, this company's on file. They need an audit committee chair, right? I don't do those. The second one, I actually have a kind of a weird business model to what I do. And I tell people that I drive 101 for a living as my job, right? So I basically drive up and down Highway 101 here in the Valley, and I meet companies. And kind of to Seth's point, like he said, if there's someone who's doing something in his space, he wants to know about it. Well, that's what I do, is I meet a lot of these companies, and some of which I meet the CEOs and I really like them. And so I offer up free consulting services for, an extended period of time as a way to get to know them. And a lot of the times in that process, I'll decide I don't like someone, or I don't like that board, or I don't like that space that much. And so when they offer, I won't be interested in it. But in many situations, those are the ones that I kind of ferret out as, the top end of my funnel of things that I'm actually quite interested in. And, those turn into like, Tonal was one of those for me, where I knew them for 3 or 4 years before I ever joined the board. So I use that as a way to kind of qualify. And then I would say the last reason I don't join a board is, honestly, I'm on too many boards, and ISS and Glass Lewis are going to kick my ass if I join another board. So I actually can't join another board.
Great, good question, good responses. I think our last question here before we wrap up, Renu Agrawal, great to see you, wants to know, have you guys seen a company go public too early? And, why did they go and what happened? And, what's your wisdom on that, things to look out for?
Well, I think to me, it's not necessarily too early is, was it a rational decision? And so I'll just go back to my beverage experience that having liquidity isn't necessarily the same as having access to growth. And so, when we were at Honest Tea, we saw companies, there were some publicly traded beverage companies, but just because you're publicly traded doesn't mean you're on a path to growth. And so there were companies much larger than Honest Tea was that were public, but we partnered with Coca-Cola and we were able to, grow our distribution tenfold. And just because you go public doesn't necessarily mean a beverage company can grow tenfold. So I think it's just as Jack and Christy said, it's an IPO is a milestone. It's not an endpoint. And so it can be a mistake to go public and then you still have the same business challenges that you had before you were public, because it's not, in the beverage world, at least, it's not access to capital, it's access to distribution. And an IPO won't solve that. So that's, I think, an important thing for a board to consider.
Yep.
Yeah, I guess the one I can think of a couple of companies off the top of my head that I won't name because that wouldn't be very nice. But honestly, sometimes you'll see companies go public because it's the last gasp at how they can find capital. And that usually is not going to end well. And so if you're going public just to solve the capital problem, I suggest you seriously think about selling your company.
I just throw in, I have 2 experiences. One was a company that, was looking to go public, and then suddenly its growth significantly curtailed because of competitor actions, and were able to sort of pull the plug and stay private. Also a company that had a lot of cash flow and didn't need capital to grow. So I sort of feel like that was a fortunate decision, because there's nothing worse than being in the public markets when you're just, your stock takes a hit, your team gets demotivated. And I also was on another board that was doing roll-ups for the first time, and hadn't got a lot of experience in integrating roll-ups, and sort of missed their targets. Missed first quarter, missed second quarter, and it just was going to be a matter of taking a bit longer. Not that they wouldn't be able to do it, but it became a penny stock. There was a lot of infighting. It became a Harvard Business School case, and how not to take a company public. And so inexperienced team and lack of predictability, as I think Jack's pointed out several times.
Alison, one thing I'd add, just as a real life example here. So GlobalFoundries, we've been doing earnings releases for the last year. So literally doing press releases, doing mock analyst calls, and they've been giving ranges every quarter to the board when they come to a board meeting. So that's the kind of discipline you want to try and get in place. This is another reason why you don't want to join right before they're going public. You really need to get in earlier, so you can make sure that this kind of discipline's in place.
Great. Other wisdoms for experiences, scar tissue, things to look out for, things to avoid from any of you. You guys have been a fantastic.
I'll just share one. I had a chat with a food company. He was talking about going public, and he's like, well, it's just so much less expensive to go public. And I'm like, oh, well, I can tell you one thing, that's not the case. There's a lot of overhead you bring on if you're doing it right, whether it's compliance. It just changes your process and your decision making. Not in a bad way if you're ready and you're at scale, but don't be fooled by thinking, oh, this is just a cheap way to raise money. It commits you to a just different behavior mode, which, you know, at scale can make sense, but if you're small, can, you know, be quite expensive.
D&O is up 5 times in the last year.
Yeah.
So,
Crazy.
yeah, it's crazy.
Yeah, I would just say it's a lot of work, and it's not cheap. I mean, it is expensive. You are going to take on a lot of costs like D&O on top of that. And I would just say to make sure, and was going to say what Jack had said, that you've looked forward to what does your public profile look like? What are your quarterly metrics? What are you going to be doing, and practice that in advance? Because I know just coming up with how to define a subscription rate or a churn rate or something, you can have 25 different calculations. Settle on those in advance, prepare them every quarter and test them before you go public, and not, you know, while you're public, it's a lot harder. So I would say really kind of look at that business model and those key metrics and be ready with that on day one, meaning having practiced like you did, Jack, or having, you know, really put a lot of thought into it beforehand.
Great. Hey, one other question that came up that I think it's worth trying to get your insights in on the topic of ESG. I think in Europe for several years now, there's been enormous investor interest in companies that have a strong ESG story and ESG metrics. And that I think many of us are seeing this become a much bigger and important dynamic in the US too. But have any of you, as you took companies public, how important has the ESG story and ESG metrics been to attracting investors, or not so much yet?
Seth, I think you have some experience on this one.
Yeah, no, I think it's very relevant. You know, when we would go out to the roadshow, we'd walk into a room and there'd always be someone in there who was representing the ESG part of the portfolio. And I would say, what are you investing in the CPG world? Because I was at a loss to think of anything. And so I do think that was an important part of our initial investor group. I think we're still getting into the mode of doing the full ESG reporting, which, you know, it's a useful dynamic. It's funny. I'll just reference, there was a recent article questioning companies like ours because we hadn't been reporting, and I wouldn't mistake impact for reporting. I mean, we will report, and it's something we'll do, but just intuitively, when you look at our environmental footprint versus the meat industry, it's not we're not 10 or 15% lighter weight. It's a multiple, and so the only thing I would just caution is reporting is important, but a basic analysis or understanding of the business should also, inform decisions too.
2 things I'll throw in here. One, I just pulled up, since I was reviewing it earlier today, the 10Q for thredUp, which, as I mentioned, is the largest marketplace for secondhand clothing. The first sentence of the overview describes the company. The second sentence says, since our founding in 2009, we've processed over 125 million unique secondhand items from 35,000 brands across 100 categories, saving our buyers X amount. We estimate we have positively impacted the environment by saving 1 billion pounds of CO2 emissions, 2 billion kilowatt hours of energy, and 4.4 billion gallons of water simply by empowering people to buy secondhand first. So yes, I believe that it's a big part of where companies will be going, and you should make a big deal out of it if you are taking a company public, and you can. We actually went after ESG investors at thredUp, and it actually worked out quite well. Usually, typically European investors, because we're not quite there here in the US. But there is a definite desire, strong desire for ESG investing on the buy side. The counter side of this is it's not very well organized, right? So you kind of have to find these people as opposed to like finding the ESG fund. And then before I went and grabbed this, before GlobalFoundries went public, this is our CSR report, and it's very comprehensive. It's 80 pages long, and it's frankly fantastic. It's on the website if you're interested. I think these CSR reports are becoming kind of a standard for companies just to show some level of responsibility.
Great. Christine, anything to add?
No, I haven't had as much experience in that with the ESG funds or targeting specifically, although, you know, that I'm sure it's coming more, and especially in the US.
Great. Well, I think this was a fantastic discussion. Great questions from everyone. I think we've worked our way through most of them. And what an incredible panel. I mean, given all of your guys' experience, we've got the wisdom of like 10 panelists here, because you both have, you know, several experiences of working with IPO companies. So big thank you to the panel. Great questions from the audience here. And overall, a really good discussion.
And thanks to you too, Alison, for moderating. We really appreciate it.
Thank you.